All right, let's bring in Michael Rosen now. He is CIO and co-founder of Angelus Wealth Management. Michael, would love to get your take on what we're seeing here. Investors coming back after the long holiday. We're seeing weakness across the board. Do you think that this is the beginning of a larger sell-off or perhaps a change in leadership for this market?
Well, certainly a change in leadership, and Alexis, nice to be with you. This change in leadership actually occurred a couple of months ago, and we're seeing that continuing now. So you'll recall back in November of last year when the vaccines were announced to be effective, the market shifted in its leadership and anticipation of very strong economic growth, and so started to favor those companies that were most sensitive to that growth. So that's where you saw the big run up in hotels and leisure, travel, areas very sensitive to the economy. You saw this in value stocks and small cap stocks, and a rotation out of leadership previously that we saw from the sort of the large tech growth companies. But starting a couple of months ago, all of the markets really have been very consistent in their message of looking beyond the most recent strong economic data to a slowing in the economy. And so we've seen a rotation back now from small cap and value stocks into large cap and growth stocks. We've seen interest rates peak. The 10-year Treasury is down about 45 basis points from its peak in January. Break-even inflation rates are down about 30 basis points over the last couple of months. The dollar actually has been sort of up and down all year, but it's up more recently. Again, now U.S. outperforming non-U.S. So really a reversal of the trends that we saw starting in November of last year, sort of back to the old leadership, which reflects an economic environment of generally more sluggish growth without concerns around inflation. So the rotation really has been pretty consistent, and the message throughout the markets, whether it's the dollar, the bond market, or the stock market, has been pretty consistent in this respect.
So, Michael, looking at your notes, you had talked about uncertainty in the markets. And then, of course, you're highlighting now this rotation back. And I feel like at least when it comes to tech and some of those big growth names, we kept seeing investors piling in and out of that space. Curious to know how investors really should be looking at some of those allocations in their portfolios now, given that uncertainty. And where are you seeing opportunity?
Right. So that uncertainty really translates into higher cash levels. We're seeing savings rates really at record levels here. Investors holding a bit more cash as they're concerned about what's going on in the world. But I think more broadly, if we look out just really even a couple of years and beyond, investors need to be invested in equities. Really over bonds. High quality bonds still have negative real yields, that is yields below the rate of inflation. As inflation likely ticks up a little bit higher, those investments will significantly underperform. So it's still true that equities remain really the place to be for long-term growth. That growth may be substantially less than, less than we've seen over the last decade, but it will be significantly greater than you could get in sort of the more defensive areas of municipal bonds or U.S. Treasury bonds. So investors still are going to have to, I think, take the volatility that comes with the equity markets in order to achieve any long-term growth in their portfolios.
Speaking of volatility, summer traditionally has been sort of a lazy time for the stock market, but not so the past few years, right? What do you think is in store in terms of volatility for this market in the coming weeks, and how might investors take advantage of heightened volatility?
Yeah, well, volatility really favors those that have liquidity, and so if you can maintain some cash, short-term instruments in order to take advantage of liquidity, or rather advantage of the volatility, that probably serves investors well. But I think really for most investors, focusing on the next few years rather than the next few weeks really is the wiser course here. And our message for longer term investors is to remain invested in predominantly equities to achieve long-term growth. One thing I will point out is despite the fact that break-even inflation rates are down and nominal yields are down, and the market's sending a very strong signal of concern about future economic growth, I do think the market is underpricing the risks of higher inflation. Again, not 1970s double-digit kind of inflation, but persistently higher inflation, which erodes the value of money, erodes the value of purchasing power of money, and again, really helps to, I think, tilt portfolios away from fixed income instruments and toward growth equities.